Hi, morning everyone. Thanks for having me here. I'm Jonathan Koh from the Global Research Team at Standard Chartered Bank. Over the next 20 minutes or so, I'll be sharing with you our global economic outlook, including on the US, China, as well as the US dollar and Asia FX, and as well as the ASEAN region. So I hope you have some useful takeaways from this presentation today. Okay, so in terms of global growth projections, we are looking at around 3% for this year, and that's a bit of a slowdown from 3.2% last year. As you can tell, the historical average in terms of global growth, at least if you look at it from a pre-COVID level, is around 3.4%. So very clearly at around 3% global growth, we are actually a bit softer. Now, for our part of the world, ASEAN, even though it's a slowdown from, let's say, 5% last year to about 4.4% this year, and I'm talking more about ASEAN 6, it's actually still an outperformer within the region. So we are kind of still in a pretty resilient and pretty good region in terms of economic growth. Now, a lot of the data that you have seen year to date basically suggests that global growth is still holding up. But one word of caution is basically front-loading. What we have seen is that front-loading has led growth to kind of hold up in the first half of the year. And if I say tomorrow Trump erases all tariffs, everything goes back to zero, growth is still going to slow down for the next few quarters. And the reason is because all the inventory that you have front-loaded has to normalize. So very expectedly, growth is going to slow down over the next few quarters. Now, on to the US. Now, this is basically some of our forecasts for the US. I wouldn't go through too much in detail. I'll basically be focusing my comments on the US on two key points, which is basically the two key mandate of the Fed. Now, in terms of the Fed, as you all know, the Fed has two key mandates. One is price stability, and the other one is full employment. So let's explore, I think, the first mandate first, which is basically the employment mandate. Now, you can see from the top left-hand side chart, whereby it looks at the wage growth difference between job stayers and job leavers. And this is basically wage growth of job stayers minus job leavers minus job stayers, or job switchers rather. And you can see that that has now fallen into negative territory. And if you look back in time, the only period when this is actually in negative territory is during periods when growth is actually very soft. For example, during the dot-com bubble, during the global financial crisis. So very clearly, we are in a period whereby growth in the US is actually potentially softening. At least that is what the labor market data is indicating. Now, the top right-hand side chart basically shows you, and this is a very good leading indicator, it shows you labor demand versus your supply to some extent. So that's basically job vacancies to the number of people unemployed. And you can see that that has now fallen to below pre-COVID average. Bottom left-hand chart shows you how employment growth is actually very narrow. Now, even though you look at NFP numbers, they kind of print okay, although I know recently there's been a huge downward revision, especially the QCW numbers. You can see the employment growth so far has actually been very narrow. It's basically led only by education as well as healthcare. Now, all other parts of the economy in terms of job growth in the US is actually slower than pre-COVID kind of levels. And lastly, the bottom right-hand side chart is something that's very important to take note of, which is what Chair Powell has basically mentioned a lot of times, is that you can have NFP numbers or employment numbers being soft, but yet your unemployment rate can still remain low. And the reason for that is because even though labor supply is falling, even though labor demand is falling, labor supply is falling as well, which therefore results in your unemployment rate actually remaining quite low. And so that's the reason that they have been saying as to why the Fed is kind of in no hurry to basically be cutting interest rates very aggressively. But I think without a doubt, just from these four charts alone, from this slide alone, you can see very clearly that the labor market is softening in the US. So that's the first mandate for the Fed. Now, the second mandate is basically concerns over inflation. So as you all know, tariffs basically, economists, we basically expect tariffs to basically show up in inflation. And if you look at the left-hand side chart, it basically shows you the dollar amount of custom duties that you collect per dollar of imports. And you can see that before Liberation Day, it was around 2 cents for every dollar of imports. Now it's around 10 cents for every dollar of imports. And that's not everything being passed through yet, because we know post-August, there's basically a further increase in terms of the tariff rates. So what we are seeing now is kind of the baseline 10% reciprocal tariffs that everyone has to pay. Beyond that, that's probably going to go higher. Now, why hasn't it shown up in inflation yet? Number one is also because of front-loading. And if you look at front-loading, what this basically means is that everyone has bought the goods earlier. US importers have bought the goods earlier at a much lower cost when tariffs were not yet in play. That's why you are not seeing the tariffs show up in inflation yet, but they are going to show up in the months ahead. And if you look at the right-hand side chart, you can also see that there is already some pickup in core PCE goods inflation, so there is a little bit of pass-through. At the same time, what you are seeing is that services inflation is actually very sticky. It's not really coming off. So the Fed is now basically in this dilemma whereby labor market is weakening, but yet inflation kind of remains sticky with upside risk. So it's honestly very challenging for the central bank, which is why they have been very cautious in terms of their moves. But of course, very clearly, we know that there is a lot of pressure on the central bank to basically cut rates. I mean, with the president tweeting every day, it's going to be quite challenging. And what's also happening in the US at the moment, I think a very key theme is also Fed independence. So I always say this, it's a scenario of your boss doesn't really like you. He goes through everything you have done from day one all the way to today, and he tries to find something. So that's maybe what happened to Kugler, who resigned, what's happening to Lisa Cook now. So it's basically they are going through one by one. So there is this question of Fed independence, and there are implications potentially for the US dollar, which I'll touch upon later. But now, in terms of our house call, we are looking for another 50 basis points of cuts this year. So 25 basis points in October and 25 basis points in December. So that's basically our call for now. Market expectations are a bit more extreme. They are looking for all cutting until 3% by the end of next year. We are only looking at 3.75%, just to give you a sense. So that's basically the US very quickly. Now, in terms of China, China's growth has also been benefiting a little bit from front-loading to a certain extent in terms of front-loading of fiscal stimulus, your consumer goods trade-in programs. But basically, here are some of our numbers, whereby we are expecting somewhere around 4.8% growth, which is what the Chinese government is kind of targeting in terms of the GDP growth numbers. And as you can see, I think the key number that I want to point out here is the inflation forecast for this year, which is negative 0.1%. And it's basically showing that China continues to remain in a bit of a deflationary environment, and therefore, and that's the result of growth being a little bit softer. And at the moment, you have seen them coming up with some supply-side policies whereby they want to reduce, for example, price competition. I mean, in Chinese, they call it 反内卷, or in English, it's called anti-involution. And you can tell that that is basically something that is pushing through at the moment, but will it be successful or not, we are a little bit less certain versus the 2015 supply-side policies, whereby it's very much SOE-led, but this time, the private enterprises have to play ball. So we are not sure how effective it will be versus back in 2015, for example. But these are some of our forecasts, and I'll touch on them later. Now, front-loading, as I noted, in terms of China, you can see from the top left-hand side chart, you see consumption has been providing a bit of support. Top right-hand side chart, you see government issuance also being front-loaded in the first half of the year. And you can see that exports to the US basically has also been helping to keep China's growth strong in the first half of the year. So actually, if you look at growth numbers here today in China, it's actually somewhere at about 5% or even slightly above 5%. And that basically is the result of front-loading of a few things. Number one is the consumer trade-in goods program, whereby basically you have certain vouchers, or you need to switch your refrigerator, for example, for a new refrigerator. They provide you that kind of vouchers to do trade-in. But how many refrigerators can you buy? Ultimately, there's going to be a limit, right? So this kind of things is going to be slowing down towards the rest of the year. And in terms of fiscal spending as well, they have already front-loaded. Now, of course, what they could do is also to bring forward some of the 2026 spending to the rest of this year, which potentially they are actually considering, given that latest growth numbers have actually slowed down. So if you were to look at recent numbers in China, things are actually softening again. And a lot of the investments that we have been seeing has again started to slow down. Now, you can clearly see that the key headwind for China at the moment is still the property sector. Now, I'm sure you all heard of this 3 red lines thing back in, 2020 or something like, I can't remember the exact year, but basically, they were trying to contain the property bubble or contain the leverage within the property sector, but arguably, on hindsight, they might have gone a little bit too far. And what has happened is basically the property sector is still undergoing a lot of weakness. And if you were to look at the data on this chart, you can see that new loans, new property investment, new home sales, etc., still remains pretty much quite soft. So this key headwind continues to weigh on China's economy, and the real estate sector is about 25% of China's GDP, so it's not small. You can talk about the other sectors like your green energy, your electric vehicles, things like that helping to boost growth, but they are not able to cover or make up for the 25% exposure that China basically has to the real estate sector. Now, in terms of China, we are looking for further policy easing, but I think few things of caution. Number one is, if you were to look at the policy rate versus the US, very clearly, the interest rate differential is very wide. So in terms of potential questions or risks on CNY stability, I think that remains there. So we are only looking for a 10 basis points cut from 1.4% to about 1.3% in terms of the 7-day reverse repo rate. And also, I think banks in China are basically very constrained from the net interest margins. So net interest margins is, I'm sure bankers here will know, basically, if let's say your deposit rate still remain high, but your lending rate goes down, or rather, sorry, it's the other way around. If your net interest rate margins get squeezed, how are you able to actually really cut rates? I think that's basically a struggle that policymakers are facing at this point in time in China, which is why they haven't been that aggressive. And to be honest, we think that the real question is more in terms of expectations and confidence in the economy. It's not so much of supply of liquidity, it's really more that there's actually no demand for liquidity. So even though your loan rates are low, people are basically not borrowing because they don't really have confidence in the outlook of the economy, in the labor market, etc. So this China drag is probably going to continue. We are looking at growth to continue to ease slowly, but not to say that things are going to fall off the cliff, because it's very clear since the September meeting last year, Politburo meeting, it's very clear there's a change in terms of the directive. I think it's very clear that they want to support growth. It's very clear they want to get rid of the deflationary mindset. So all policies are basically targeting towards that. And you know, when China puts their mind to it, they can basically push for these things to kind of be done, although it may take some time, because they are also cautious that they don't want to over leverage. In fact, one of the key reasons why we are seeing a bit of a slowdown in China is they themselves were deleveraging. They were pushing for deleveraging because they didn't want any bubble. And that happened in 2018, 2019. So that's basically the very quick summary or outlook for China as well. Now, next slide. Yeah, now moving on to ASEAN, a very quick review. Next slide. Okay. Yeah, so in terms of ASEAN, very quick review of H1 before I touch into the outlook. First half of the year so far has been pretty resilient or pretty stable, and that's really front-loading. In terms of if you break it down by GDP, by expenditure or components, you can clearly see that household consumption remains pretty much quite resilient, and that's really because the labor market in ASEAN actually remains quite strong. If you were to look at unemployment rates around the region, it's actually below pre-COVID kind of levels. Now, when you look at bottom left-hand chart, you look at investments, that has kind of held up in some extent driven by public investment, so basically government capex. But we think it's probably going to slow down towards the rest of the year just because of the uncertainty. And you also have pickup in exports that has been driven by front loading. So overall, first half of the year, ASEAN growth has held up pretty well. Now, in terms of inflation, what has happened to inflation is inflation has basically eased, and we don't think that inflation is going to be an issue for ASEAN over the next few quarters at the very least. I mean, you have low oil prices, you have China exporting deflation, etc., etc. You have demand kind of remaining a little bit soft. So inflation is not going to be a problem. And on the back of softer growth, as well as subdued inflation, what we have seen is basically central banks further cutting rates in our part of the world. So we saw, for example, MAS easing monetary policy, BNM cutting rates, BI cutting rates, Bank of Thailand cutting rates, BSP cutting rates, etc. So, and that we think is going to happen through the rest of the year as well. Now, of course, I cannot talk about the outlook without talking about tariffs. So here's our very quick take in terms of what's the impact on tariffs. So I think at the start of the year, what we saw in terms of tariffs, I think it's much higher than what we expected. I think everyone came into this year expecting Trump to impose tariffs, but we were expecting tariffs at maybe 10% universal and 20% China. What came on Liberation Day was way higher than that. And even after the trade deals were being negotiated, what came out was also, in the end, higher than the initial expectations. But of course, Trump being a very good negotiator, everyone is like, thank you very much for the lower rates, even though we are all paying much higher than what we used to pay last time. So this is basically a very quick summary on the tariff rates. Now, in terms of the impact, now we made an estimate in terms of the impact to GDP growth, and the impact on GDP growth is dependent basically on a few factors. Of course, a lot of these are estimates, but we basically have some assumptions that we're working on. So number one is, how open is your economy? Number two is, what percentage of items are basically exempted? So we work off the current tariff rates, we work off the current exemptions, and we work off what value add that you actually input into the exports that you ultimately export to the US. And you can see from this chart, bottom left-hand chart is basically the key one, is that Vietnam is probably going to be the most hit. Our estimate is around 1% of GDP growth, annualized, but it's much lower than initial Liberation Day numbers, which is over 3% hit to Vietnam's GDP growth. And this, bear in mind, it doesn't take into account the second round impact. And what I mean by second round impact is that an economy like Singapore faces only a 10% baseline tariff. But is everything really all clear? Not really. And the reason is because you look at the right-hand side chart, Singapore's economy is extremely dependent on external demand. 65% of our economy is driven by external demand versus the likes of Indonesia, Philippines, where 80% is driven by domestic demand. So if global trade slows down, very clearly Singapore's growth is going to slow down, even though our baseline tariff is only 10%. And also that lingers uncertainty of sectoral tariffs, semiconductor tariffs, pharmaceutical tariffs, etc. That continues to, I think, weigh in the background. So this is basically our estimates in terms of the hit to GDP growth from tariffs. Now, that's really in terms of the short term, but what about the longer term? Now, I think we all know that global trade has basically peaked since global financial crisis, if you look at global trade to GDP, and what has been happening is really regionalization. Now, I'm borrowing a kind of a Standard Chartered term here, but South-South trade has basically grown since over the last, two to 3 decades. You can see that it was only a very small blue bar, less than 10% at the end of year 2000, but at the end of 2024, it's something like almost 20% of global exports, essentially. So you are seeing global trade slowing down, globalization slowing down, but you are seeing regionalization picking up. So in terms of your RCEP, ASEAN doing FTAs with China, with Korea, Japan, etc., all this kind of contributes towards regionalization. Now, a more medium-term look in how ASEAN stands when you take a look, when you take into account the US-China relationship. Now, the US-China relationship, regardless of who is the president, is not going to change. In the sense that if there's only one thing that Democrats and Republicans agree on, is to go hard on China. So ASEAN has become a very important middleman. You look at the top left-hand side chart, you can see in terms of US imports from China has fallen, but US imports from ASEAN has picked up. Bottom left is the other way around. It's basically China exports or rather US imports from China has fallen and ASEAN imports from China has basically picked up. So ASEAN has been a growing middleman. But one thing that is, I think, important to highlight is everyone talks about transshipment and the potential risk of transshipment to the region, especially Vietnam. But we argue that actually, over the medium term, when you take into account that they are so strict in terms of rules of origin and how much you actually value add, because transshipment is all about value adding, right? If you basically don't value add and you just re-export out, that is considered transshipment. But if you actually value add, then it wouldn't be considered transshipment. Of course, the exact threshold and details are not out yet from the Trump administration, but basically my point is that over the medium term, perhaps we can actually move up the value chain because companies will actually have to invest properly in ASEAN. You cannot just treat the destination as a transshipment hub. So that is actually a potentially positive thing, especially for economies like Vietnam. And the bottom right-hand side chart, I think, to leave some numbers with you guys is ASEAN remains a very attractive FDI destination. It only accounts for 3 to 4% of global GDP, but it accounts for 15% of global FDI. So very clearly you can see the investment interest in ASEAN remains high. Now, of course, in terms of the short-term challenges, it's basically, as I noted, export growth is going to slow down. Investment uncertainty or elevated uncertainty will weigh on investments. The only key thing that is really supporting growth, or in a way growth not falling off the cliff, of course, is you have labor markets kind of remaining steady. But of course, that depends on how much weakness is will spill over from the external sector to the domestic sector. But at the moment, I think we still have a relatively benign outlook for the region. Now, inflation is not going to be an issue this year. I think we basically expect growth to inflation to basically remain low. It's going to remain within central bank inflation target ranges. And basically, as I noted, in terms of global oil prices remaining low, China still exporting deflation, demand basically not being a concern, so inflation is going to remain low in our part of the world. And that basically opens up the door for further monetary policy easing. Now, other than growth and inflation, one thing that has helped our region in terms of monetary policy easing is the weaker US dollar. So some central banks in our part of the world, like BI, BSP, they are more sensitive to exchange rate pressures, and FX stability, I think, is a key mandate. And the fact that the dollar has weakened has basically opened the door to further monetary policy easing by central banks. Now, that's really it for the economic outlook, and over the next 5 minutes or so, I'll go through in terms of the FX. Now, I think the dollar move has been pretty much quite counterintuitive. Why do I say that? I mean, if you look at pre-Liberation Day, I think what we were expecting logically is, or by theory, is that US imposes tariffs, inflation picks up, Fed has to tighten monetary policy, interest rates go higher, or interest rates stay high, and your dollar remains strong. But what has happened is that the dollar has actually weakened sharply, especially in the first half of the year. So that's why we say it's very counterintuitive. And the reason for that is because there has been a hit to confidence. So if you look at the top left-hand chart, it basically shows you post-Liberation Day. The post-Liberation Day Fed markets basically priced in a lot more Fed rate cuts because the tariffs that were imposed or announced on Liberation Day was much higher than expected. And of course, one of the policy uncertainty that's happening in the region has also led to questions over US dollar as a safe haven currency. Bottom right-hand chart basically shows you now, whenever VIX usually spikes, the dollar usually does better. But what happened this year is when VIX spiked, the dollar actually weakened. So very clearly, you can see a little bit of a loss of the safe haven characteristic in terms of the US dollar. Now, one key reason as to why the dollar has weakened sharply is because of heavy positioning. And what I mean by that is basically since 2019 to 2024, almost $7 trillion of money inflow into the US to buy US equities. As a percentage of GDP, that's around 20% of GDP. So that's very huge. And equity investors, as you all know, don't hedge their FX. They basically leave it because equity volatility is higher than FX volatility. So what has happened is basically because of the sharp move in the dollar actually weakened 12% year to date during a period of time in H1. And that move was so sharp that it caused equity investors to actually have to go and hedge the FX. And that basically led to further dollar weakness. Now, I'm running out of time, so but we cannot rule out the dollar yet. I think there's this whole sell America narrative, which we don't think is true. You look at bottom left-hand side chart. Yes, April, there was $50 billion in terms of sales of US equities and debt. But in May, you saw $350 billion of inflows. So we think the sell America narrative is not true. Data definitely doesn't show that. Now, moving more quickly towards ASEAN Asia FX, and this is basically my last slide. The tailwinds that have supported ASEAN or Asia FX in the first half of the year is now becoming headwinds. Now, the first tailwind, of course, is I think if you look at the currency performance year to date, I think it's quite interesting that the externally oriented currencies are doing better. Now, you would think that the externally oriented economies and the currencies will suffer because of concerns over tariffs, global trade slowing down. But what has happened is they have done better. And why? I think one key reason is there was a lot of focus by the Trump administration on this, on potentially currency as being part of the deal. And you saw the situation with Taiwan dollar appreciating 5% in one day, intraday, and that basically also led to hedging of Taiwan dollar being very expensive for your Taiwan lifers, and they basically did proxy hedging. So your currencies like Korean won, Sing dollar, all kind of done better. But basically we think that that narrative has kind of faded a little bit. Currency deals don't seem to be making much headlines now, and a lot of your Taiwan lifers potentially that proxy hedging demand that we saw is not going to be as large as the first half of the year. So that tailwind is no longer going to be there for Asia FX. Front loading of exports very clearly has helped current account balances in first half. That's not going to happen in second half of the year. Now, if you look at Asia equity outperformance, that has kind of been a key driver of Asia FX against the dollar. But very clearly, the outperformance seems to have dwindled. You see US equities again now reaching all-time highs, Nasdaq, SPX, etc. And lastly, the last factor is if CNY doesn't appreciate, how is Asia currencies going to appreciate significantly against the dollar? The reason for that is Chinese goods are already cheap. If, let's say, you let your currencies appreciate against the CNY significantly, it's only going to let your domestic producers suffer. So basically, those are all the reasons, which is why we are actually against consensus here, or non-consensus. We are expecting a little bit of a rebound in dollar and in dollar Asia towards the rest of this year, rather than everyone expecting kind of a weaker dollar through. With that, I've come to the end of my presentation. Thank you.